going to record this, and good. I am going to put these on YouTube, by the way. Initially I was not gonna, and then I said, well, it's kind of helpful to put it on YouTube just because I can get two things for the price of one, if that makes sense. So I get two, hang on a second, let me get my chat. Okay, there we go. Well, how do I get the, I'll go here. Oh, to it's in attendees. Hold on just a second. Oops. So how do I get the thing where you guys can participants? Oh, there we go. All right, sweet. Hey, sweet. All right, cool. So now that Dan's here, we're going to start with a little bit of right capital stuff first. All right, all right, cool. So good. Maybe you get more people to you. Where'd that go? Hold on a sec. Oops. If they see what we do here. Yeah, I don't know how to. The webinars. Yes. I guess what I could do is limit to 10 extra people a meeting, if that makes sense. That's not a bad idea, Jim. I was wondering how I could do that in terms of, like you had said, your thought process was you could make it so more people can have access, can see what we do here. And I was like, I don't know how to do it to just limit it, because I don't want everybody to sign up here, show up here. You know what I'm saying? But if I could say, look, for the first, 5 people, a week, you can see what we do here. That might be a pretty good idea. I just need to tell more people about it, be honest, about what I do on Subscribestar. That's a good idea, Denise. Yeah, there you go. I say, look, we do this every week. And, if only 10 people show up, 10 people show up. If 20 people show up, 20 people show up. If 50, I got, 57 people now? It's almost 60, which is pretty cool. I appreciate that. It's $600 a month, man. I'm much obliged. I'm incredulous. But I guess it would be sweet to have more, obviously, because I think you have more of a familial, if that's the right word, group of people. But I was getting ready to say something about that. No, I just don't say it. I hate these videos. And I used to do this too. Like, don't forget to subscribe, hit thumbs up. That drives me up the wall. And I used to do that. I don't do that. I haven't done that for about a year. I refuse to do that because people on YouTube know how to do that, I would think, by now. It seemed like I was going to say something else too. I don't say ever, hit subscribe. I mean, I might say it on occasion, but not very often. And then, like selling your courses and stuff. I don't like all that. I'll do it on occasion with specific video, but I don't like those videos where it's all sales thing. Make a commercial and put it on YouTube. I did advertising on YouTube when I first started out, Jimmy. It was actually enjoyed it. It was fun because you can actually pick and choose like what is fun. Anyway, we'll get into that, but I appreciate it for sure. I did do that. I enjoyed that a lot, as a matter of fact. I might do it again. I just, to be honest with you, I was only doing 1 video a day, then I was doing 2, now I do like 4 or 5. I just posted one right now while I was walking. This is a market pricing a Trump re-election. So I just posted that right now for your enjoyment. And then, so you all can watch that one if you get a chance. And then, because I do, let's talk real quick about the markets. I noticed the S&P 500 is now above 3,000 again, is at 3,033, still down roughly 10% from his bottom, from the top. I mean, so if I would have told you back in the beginning of February that by the end of May we'd have a 10% decline, you would have thought that's pretty damaging. You would have said, "Ooh, that's not good," and you would have been right. But because remember, the markets are always about 3 months forward looking. All right, they're always forward looking. So if I would have said that, you would have thought, oh, that's a 10% decline from February to May. The drawback, of course, is that what we had a 4-week time from the middle of February to March 20th. The market fell off a cliff, and now it's come back around. The drawback about how the markets come back around though is I don't think people get it. If you start at 10 and you fall to 2, that's an 80% decline. If you climb from 2 to 4, that's a 100% increase. You're still way down. And so while the economic numbers might be good, relatively speaking, to the bottom, it's still freaking piss poor relative to where we were, just 4 months ago. And I sit there and I don't see how we're not. Look. I'm glad the numbers are looking good. I like that. I don't think. I'm not optimistic in the short term at all. I'm pleasantly surprised. But you have 35 jobs lost, 35 million. That's crazy. Anyway, so let's dive into it. So but remember, the markets are always forward looking. They're not hindsight. They're always forward. And if they're thinking August is at the end of this, so we got June, July, August. So the Q2 ends in June. Then Q3 would be July, August, September, and that will probably go a long way to determining the election. And if the markets are thinking by the end of August we're going to be in a good place, I imagine there'll be some momentum steamrolling effect to continue on that they would expect a Trump win. And as much as the markets are globalist in nature and corporate capitalist, crony capitalist, as opposed to Main Street, Wall Street, they don't want freaking what's his name winning with what's her stupid name, AOC, and the Green New Deal, and what's that guy's name, Beto O'Rourke being in charge of guns. They don't want Biden in there, man. I know they know Biden's a corporatist, but man, Biden's not calling the shots. His handlers are calling the shots, and so his handlers are going to get steamrolled. They're going to steamroll these corporatists, and they might bend over backwards to China, but they don't want that. They want a Trumpster win, even though they have to grin and bear it because they know the alternative is a Green New Deal and Elizabeth Warren, and they don't want that. And heaven forbid, Stacey Abrams. I don't get the appeal of this lady. I literally don't understand it. Of all the lefties out there, there's tons more that are, I think, more was legitimate than Stacey Abrams. I mean, she's a freaking state senator for a couple terms. Wow. But anyway, be that as it may. We'll see how it shakes out, but yeah, exactly. You're still over $100,000 down, says Denise. Jimmy says his portfolio is more today than when this market started dropping. I frankly, because my stuff is now at Schwab, I don't even know how to log in. I haven't looked. All right, so I want to do something. Daniel, I want to ask you, if you don't mind, because I want to share with you what Daniel showed us. Right here, I think. On how to do, all right, so we're gonna go to Right Capital, and hopefully he's still here. Hopefully, okay, it looks like y'all can see the chat, sweet. All right, so I'm gonna go to this investment. All right, so let me move this guy out of the way. I'm gonna delete this chat right here. All right, so you see this, this balanced, you all can't see this when I change it. I mean, you can see what I change it to, but you can't do all this. So Daniel, if you put a link, Daniel, to your YouTube channel, showed us how to do this so you could. And it had something to do with right-clicking here. And then, well, I'm on Mac now, so I'm not sure if I'm doing it right. What did we do? Hold on a second. It had something to do with right-clicking in here. Yeah, I can't remember. Post the link to your, it's not working. Maybe it's because I'm on a Mac. Look up, undo. No. Anyway, post the link, Daniel, to your, hold on a second. Your YouTube channel, would you please? Oops. So people can see. Is he doing that? Let's see, how to do that? Because what I'm trying to, I know it's not making sense. Bear with me just 1 second here. The participant. All right, there. All right, sweet. Yeah. All right, good. So let's. All right, cool. So I'd like for you guys to go, and don't forget, if you want to ask a question, whatever, raise your hand. And I think you just got a thing that says raise hand down there. So let's go to his. There we go. Sweet. Now I'm going to share my screen again. Let's go back to, hold on just a second. I'm going to pause this.
I'm going to go over how to create.
All right, cool. So bear with me just a second, guys. I'm trying to figure this out while we're doing this. Okay, cool. Now let's go to share screen. And right there. Share. All right, cool. All right, sweet. Good, good. All right, fantastic. So, all right, so this is Daniel's thing, and it's unlisted. I'm going to subscribe. Can you okay, cool. And so, right capital enabled target allocation, bookmark creation, bookmarklet creation. That's what it was. Now, I'm in a Mac, so I'm not sure if you can't do it in a Mac, Daniel. You can post this link to Subscribe Star. Yes, I will. Absolutely, absolutely. I will, Denise, for sure. But if you, so what he's saying, if you right click in the URL, whatever it's called, the web address thing, I'm drawing a blank what's called, and I'm not able to get that. So I'm not sure. Bookmark bar, yeah. That's not the bookmark. Oh, so you're saying right here. Okay. Oops. Okay, add page right there. All right, that's what it is. So here, this is my bookmark bar. I got Amazon, book formatting, calculators, Census Bureau, CNC, continuing care, American funds. So you just hover over here and you right click and you hit add page. And then Daniel's got a whole thing that you want to do in terms of this thing right there. I cannot stress this enough. And what's going to happen is once you do that, you'll then be able to see all these things with the rates of return, the standard deviations and whatnot. It's freaking cool. Daniel knows how to, Daniel, by all means, post anything you've got on your YouTube channel, man, when it comes to anything you want. But when it comes to this stuff, Daniel is able to, I don't know how he does it, to be honest with you. He's able to get this information from Right Capital and use it, which is freaking awesome. No other way around that. I'm stunned, frankly. But anyway, so do that. Anything you want to post, Daniel. So again, his I'll put a link to his to this channel, and I would suggest you subscribe to him. Hopefully, Daniel will do more. You can see I like watching Clay Travis, Wrangler Star. So that's some of the videos I like watching. I probably should have gone on an incognito thing, but anyway. And let's see what kind of chats we got here. We got just me. So Daniel, okay, yeah. So let me show you something else about this. So another thing that we all found out from last week. Okay, so if we go to retirement and we go down here, and we go down to action items, it turns out that you guys don't have access to these two. Did I already say this to you? I don't think I did. I think last week is when I said I'm going to look into this. And I was like, what are you talking about? So I emailed Right Capital. I said, what are you talking about? They said, no, you only have access to these 7. I said, that doesn't make sense. I said, well, tell them that that's stupid. Look, I'm not getting rid of Right Capital, but that was dumb. I said, get rid of it, man. We don't need to add that stuff. What's the point of me being able to create it if you can't use it? That didn't make any sense at all. So I think the 2 Bobs are the ones telling me about that they did not have access to these 2. I could have sworn some other people did, but I don't know. But anyway, long story short, I texted Right Capital, whatever, and the guy initially said, you do just clean out your browser, your cache and all that, and it should show up. And then one of the Bobs said they didn't work. And so I emailed Right Capital again. They said, oh yeah, it turns out you don't have access to it. I was like, well, that's dumb, man. I don't get that at all. Actually, do you all have access? Daniel, do you all have access to on this thing right here on the target allocation? If you could look at yours real quick, at least here, hopefully you have access to these 2 guys. I mean, not that it mattered much because you can't really do anything with it, but that'd be kind of cool. Anyways, that was kind of frustrating that Right Capital didn't allow that. I didn't understand that. Right Capital, what else they don't? There's something else they don't allow. I forgot, but you have access to this right here. There's something else they don't allow you guys access to, which I wanted to. I can't remember what it was. Yeah, I can't remember. Anyway, B doesn't matter. I forgot. So we'll stop sharing there. No holdings tab. Huh? Really? All right. So let me go. Let's share again. You all don't have access to. You don't have access to that right there? Oh, Bob A says that. Okay. All right. Gotcha. Nope. Huh. That might be something I was doing then. All right, so let me try something and stop sharing. All right, so what I'm going to do while you guys are hanging tight, I don't think you guys can see what I'm doing. Let me. I guess you can't. You can't see what I'm doing here, right? Are you all? What are you seeing right now? I just want to make sure I'm not disclosing anything. Well, are you seeing me, or are you seeing a right capital screen right now? Are you seeing a right capital screen, or are you seeing me? If just you, okay, cool. You're ugly, especially getting all sweaty. All right. So what I'm going to do is, Daniel, I'm going to go into yours real quick, and I'm going to. All right, there's my man Daniel, and what we're gonna do is click on this. Oh yeah, all right, cool. I didn't check holdings. I don't know why I did not check holdings. All right, so let me get out of this. Boink, boink. So Daniel, try yours now and see if you get holdings, because I just changed it where you should be able to. Actually, did I save that? Hold on a second. I gotta make sure I saved it. And oh man, all right. Hold on a second. Blink. All right, got it. Sweet. All right, cool. So I can do that. Fantastic. All right, so good. So I can let me get out of here again. Blink. Oops. There. Stop share. It doesn't get much more high speed than this right here. Let me tell you, this is first rate. This is classy. All right, so sweet. So Z-Man, right on. Welcome aboard, my friend. Sorry about the sweat. Just if you all are new here, I just got back from walking old Pablo, and man, it's like I said in my video yesterday about Georgia moving to the land of the free. It's whoo, man, it's humid down here for sure. All right, so I need to go and add holdings. I just got to check this little button, add holdings. So yeah, right on. So if you guys have other stuff that is not showing up, I don't know what else it would be, frankly. I don't know. So anyway, just keep me apprised of what's working on there, what's not. Don't inundate me with 1,000 emails. But it would be kind of cool, maybe once a week, just kind of if we come back on here, we'll do like 15 minutes of right capital for sure. All right. So one thing I did want to talk about, Vanguard had us, and if you guys have questions, thoughts, and concerns, just raise your hand. I have the chat up here as well. All right, cool. All right, so I want to go to Vanguard's thing on inflation real fast. They had a study that came down the pike today that I was reading. Where did I do it? Hold on a second. About Vanguard's inflation prospects. I just thought I'd share this with you real quick. Because I mean, it's just is more insightful about there's just no inflation coming down the pike anytime soon. And I want to kind of get into this a little bit more detail, because I think a lot of people overlook this. All right, so right now, the greater likelihood is disinflation. I think a mosquito just went flying. Oh God! Oh man, I miss them. A greater is a disinflation, a slowing in the rate of inflation. Oh man, what the heck? It's like I got some kind of bug flying on me, and I'm like in what's that Stephen King movie, The Mist? Jeez, these bugs flying all over the place. All right. The data underlying a 0.4% decline in April in the U.S. core consumer prices is the largest monthly drop on record, hinted at what we could see in the months ahead. Vanguard expects that the effects of diminished demand will outweigh upward pressures on inflation, given increased unemployment and consumers' general reluctance to spend. But eventually, any lingering impact on supply chains, the sizable debt government overhang, and a U.S. Federal Reserve willing to tolerate somewhat higher inflation could win and push prices higher. But they're saying in the interim, in the short term at least, that there's no inflation coming out of the pike, and I could not agree with that more. But I want to share with you something. Inflation is the anomaly in the United States. It is not the default. I stress this. I cannot stress this enough. That we just don't have a history of inflation in the U.S. We had some during the wars. All right, I get that, but wars are usually inflationary because it's nuts. And we had right here the 70s. They say this isn't a 70s supply shock. Arab nations' oil embargo of several primarily Western nations famously played a role in the double-digit inflation in the 1970s as wages spiraled higher amid expectations for ever higher prices. Well, there's more to it than that. It was Nixon price and wage controls as well. So we had an oil shock. We had essentially Keynesian socialistic policies by Nixon. Don't forget, that's where the EPA came. I think MEMSHA, or Mine Safety and Health Administration, OSHA, all that crazy stuff came from Nixon, man. Nixon. And that was a big blast in terms of scarcity policies, for sure, because Nixon had this huge, it's no different than saying it just is not. So anyway, so and it's funny, UBI, Universal Basic Income, was a Nixon baby. He was the one who initially was thinking about that, just give everybody some monthly money and be done with it. And I'd much rather have that as opposed to having these bureaucrats on top of bureaucrats on top of bureaucrats. Just give the money direct to the people. Let them do as they want. If they freaking blow it, then I'm sorry. We gave you the money. Get rid of the bureaucrats. Save a boatload of money. Anyway, supply disruptions related to the pandemic, on the other hand, most recently threats to the meat supply are likely to affect a broader array of goods, but are set against a different backdrop. Weaker demand could counter the inflationary effect of the reduced supply. Although inflationary pressures could arise if demand returns before supply does, we can't say with certainty when consumers, this is critical right here, we can't say with certainty when consumers may be ready to spend at the same rate as they did before the crisis, or when suppliers may be able to return to normal levels. I'm telling you, the consumers, and I also have something else I want to talk about too, about clients I talked to today. If the consumers don't spend, then there's no inflation. It's just not going to happen unless there's socialistic price controls. But that if Trump wins, that's not going to happen. Which is why I think the market is starting to price in a Trump victory, for sure. But if consumers are sitting on their hands because they're like, look, even if I have to pay, let's see what the negative rates are doing here. Bear with me just a second, my friends. I'm going to look at, let's see what the rates are doing across the world now. Oops. Because if negative rates are still, I guarantee they are, people are saying, I'd rather lose, 1/10 of a 1 percentage point a year to keep my cash, as opposed to losing significant amounts in the bond market, the stock market. Or if I don't have a job, having to take on debt if I can't get a loan. You see what I'm saying? So the way I look at it is like, man, people are just going to casually spend money if they're worried about their job security, if they're worried about where their paycheck's going to come, if they're worried about being able to pay the mortgage. Did you see today the Oakland A's are not paying their minor league people? They have like 250 people in the minor leagues. None of them are getting a paycheck. They don't get much to begin with. They're furloughing some of all of their scouts. I mean, this is Major League Baseball. You know what I'm saying? And you think if the A's do it, that's going to be the only team? No, lots of people are going to do this. Not inflationary stuff. So if we look at bond markets here, let's go to UK, because I think one of you guys said the UK had negative interest rates last week, and I looked up. I said, man, you're right. It's nuts. So if you look at, I'm looking at the UK right now, and we go to. Hold on a second. Where markets right there? Yeah, right there. Government bond 10-year. So in the UK, the 10-year is 20 basis points. So 0.193%. That's their 10-year in the UK. Their 3-year is still negative. That's 3 months. Excuse me. Their 3-year is still negative. The 5-year is negative. The 7-year is negative. Yeah. Oh, wait, no, that's not, hold on a second. No, it's not, excuse me. They're 3 years negative, that's it. Everything else is positive. But they're 20 years at 0.5 of 1%, the 30 years at 0.61. Their 5-year is literally at 1 basis point. I mean, people are saying, I'd rather make no money than risk losing it. I don't know, I hope that makes sense. I just sit there and I'm in awe of people saying they're not just going to gradually or casually start spending money. And here's Germany. They got negative yields across the board. There's everything is negative other than the 30-year, which is at 0.03. I think that's actually the 30-year is the first time it's been positive for a little bit. So, the 30-year of Germany has been negative for a little bit now. Yeah. So basically for the first time it's gone positive in a month and a half. So the first time you've actually got positive interest rate in Germany in a month and a half. That's freaking insane. That's insane. And we'll just, as always, look at Japan here. All right, and this is going to lead me to something else I want to talk about. And if you guys, again, if you have questions, thoughts, concerns, let me know. So Japan, as we always look at Japan as our proxy, negative across the board, except their 30 years now positive at 0.48. Wow, I'm surprised to see that. So the Japan 30-year, you're getting 0.5% in the Japan, which is the first time it's been positive. All right, no, it's been positive for a little bit here. But anyway, so even that though isn't, yeah, so the Japan is positive now. So basically what's happening here is you can see across the world, rates are way low and they're not going up anytime soon. And because they're not going up anytime soon, and they're certainly maybe going down, but people are willing to risk losing a little bit and not make any money as opposed to risking it all on a job loss. All right, something else I want to chat with you about. So I was talking to these guys, I call them friends, clients, friends up in Chattanooga. And I investigated their thing about going to Lanier Village, Lanier Estates, Lanier Village as a CCRC, a continuing care retirement community. And last year was it 2 years ago now? I guess it's 2 years ago. And I actually investigated that place for them. And I told them, I said, I think you guys are too young. I mean, she was in her late 60s. She's now just turned 70. He's in his low to mid 70s. They're literally just good looking couple, wonderful people. She has a little bit of issues health-wise, nothing horrific, but just a little bit of concerning. He was in a car crash last year and maybe 2 years ago. But other than that, I mean, they're not in bad place. They're in good shape, relatively speaking. They like Chattanooga. But the issue that he brought to my attention, I had never thought about this. Should you even go to a nursing home anymore in this day and age when, the governor of New York and places are forcing nursing homes to take patients with coronavirus, basically sentencing them to their deaths to some regard. I mean, and then he was saying at the CCRC, they said they had to deliver they couldn't leave their rooms. They had to get their food delivered. I mean, it just sounds like, you're a prisoner in your own home. And he says, at least in our house, we don't have to deal with that. So that's an interesting thing to me. I said, I wonder what that's going to lead to in the future. A new business that says, instead of you being at the risk of Governor Cuomo or Half Whitmer, we're going to have businesses that are going to come to you in the safety of your own home, more so than long-term care facilities, assisted living, and nursing homes. If anything, this has been an awakening that you have no control over your body. My body, my choice. Yeah, apparently not. And so because of that, it's just an interesting thought. I never thought about that, but that would lead me to believe, guys, that as opposed to looking at nursing homes as a place if you have Alzheimer's, we might need to take a different thought process as how are you going to get someone to come to your house? And I wonder what kind of businesses are going to come because of that. My next door neighbor brought her mom home from the nursing home. Man, look at that. I'm telling you, and I don't know what to make of that. We were having this discussion because their concern was, they got some pretty good offers on, non-solicited offers on their home. They're like, maybe we should just cash out, take the money while we can, because who knows where the real estate market is going to go and whatnot. And then, and just basically lock in our cash and go lease a place or something like that. And before we go to a CCRC, and I said, we just got to chat. I said, do we even want to go to a CCRC anymore? Now, continuing care retirement community, what happens, guys, is they have these cottages where you're independent living. Then you can move up to independent living in the apartment. Then you go to, what's called, you go to independent living, assisted living. So you go to independent living in a cottage, independent living in an apartment, assisted living, and then skilled care when you basically got dementia and whatnot. A lot of countries like in Asia just live with their kids or have live-in aides over nursing homes. I don't know what that will make. It's interesting. Something like, oh, thanks, girl. Hey, there's Chloe. Chloe, say hello. You got, look, every day is Veterans Day at USAA. Oops, you can't see. You look, you're a ghost. Okay. Well, anyway, Chloe says hello. All right, well, that's Chloe. She brought me my hot tea because I love her. Don't tell her I love my daughter. We don't want her to know that. Nursing homes have been bad for a long time. I think this is awakening. My biggest goal is avoiding one. That's, yeah, see, that's, but Jill, your long-term care insurance covers it. But who's going to be the provider? See, that's what I'm saying. And I'm not saying it's not, I'm glad I got long-term care. But I would think the long-term care or any kind of policy should be where, I don't know. I don't know. Like, who's going to provide the coverage? Like, are there, you know, what's that lady, Joan London? She advertised Living Angels or something like that. I just wonder what's going to happen. I mean, because it's going to be a business dynamics that comes in this for sure. I guess they could always convert those private prisons to nursing homes. Yeah. Yeah, but who wants to go to a nursing home? That's what I'm saying. I wouldn't. And so what do you do instead? In fact, it's interesting. My sister just texted today that my mom is, I'll tell you what, all right. So my sister says, she says us kids need to have a plan for a nursing home for our mom. Doesn't need to be today, but my mom said that's what kids do, is they have a plan for the mom for a nursing home. And then there's an application my brother has, but it has pages and pages of medical history, which we have to fill out, and we don't know the knowledge of. But the issue is that I'm sitting there thinking, you know, this is like Denise said right there with her next door neighbor. Jill's talking about that. What's the, what are we going to do? I don't know. I don't know where it goes. I mean, I wonder. I don't have an answer. I just think there's a business opportunity here, that people are going to be a hell of a lot less inclined to go to a nursing home, and certainly buy policies that will go to a nursing home when we see the damage that has been done. I mean, literally, take away New York. I think it's like a half or a third of the deaths of the comedy virus come from New York City alone, just for the whole United States. Just this horrible management. And yet those people was like against the law, essentially. The whole thing's crazy. You can get home health care now. My dad had home health care for years with Alzheimer's. My mom insists on not sending him there. But taking care of him for 8 years ended up killing her soon after he passed. Well, that's those people up in Chattanooga. You know, the interesting thing is one of the reasons they're thinking about selling their house is because it is becoming harder and harder to maintain. I said, well, just, you know, they got the cash, so just hire somebody. They go, oh, we do. We got help in here. It's just we're getting them more and more and more. I said, no, I get that. That's a challenge to, you know, get one of these maintenance-free places. Anyway, it's an interesting. Why not just get a condo instead during your old age? I think that's, we've got a Q&A. I think that is probably going to happen more and more. They're going to be condos and stuff. Who wants to maintain property and whatnot when, I mean, who wants to do that? I think the condos would see an influx of people. And then on top of that, like if you think about the villages, that's not a nursing home community. It's not. It's I guess over 55 or something like that. But essentially, you have maintenance free, right? You don't mow your own lawn. You hire through the HOA or whatever they do. You know, they have all these hospitals and doctors' facilities and all that all around the place. I'm sure they got lots of orthopedics, lots of, you know, the people make shoes for it and whatnot. I would think there'd be more of those places, except for condos, sprouting up all over the place that aren't really nursing homes. It'll be interesting to see. But I mean, is a nursing home just semantics? No. I mean, could you say, because we have one they just put up here in Milton, where I live in Milton, Georgia, that's brand spanking new. Is it considered a nursing home? I don't think so, but it's nursing home patients. Half of the rest of the virus deaths are nursing homes. So a third New York and 50% or more of the other 2/3 are nursing home deaths. It's freaking crazy. I mean, literally, it's like they were forced to die by the government. All right, so everyone should hit the chat button and click all panelists and attendees to be okay. Gotcha. So Jimmy says if you're chatting, make sure you hit chat, and then it says it'll be a thing that says to all panelists and attendees. So I'm the panelist. There's only one panelist. You want to make sure you hit attendees too. So there should be a drop down when you hit chat. It'll say all panelists, which would just be me. You want to hit all panelists and attendees. Make sure you do that. Yeah. Okay. Like for instance, there you go, Bob. Bob says he typed in all panelists and attendees. Denise, you're just doing all panelists. So put all panelists and attendees if you would. All right. So we got a Q&A here. based on the scenario, are people who are heavy into buying tips insanely misguided? I would say, thanks, Denise. I want to say insanely misguided. Look, I mean, you know, the longs. I'm going to show you guys again. I'm going to show you guys again. The issue that we got with inflation is the exception, not the rule. So let me share my screen with you, and it's just so we're going to go here to. Maybe y'all can see this. All right, cool. So we're going to go to. This is my book I'm working on. It's not going to be done by the end of this month. I just get too caught up in different scenarios. You can see all kinds of scenarios. It's going to be fun. It's fun. But anyway, so I'm going to go to, hold on just a second. Historical inflation. All right, so let's look at historical inflation. And we're going to show you guys, blink, that inflation, and I share this with you every time, but we have, I mean, look at this. Negative, 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 that's in 1800s. Negative, 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 zeros, just nothing. Nothing to speak of until about 1918 or so. 1916, 17, 18, 19, 20 during the World War II. Deflation, deflation. But anyway, let's fast forward. So we had in 51, 53, 54, we had, 51. That's it. We had 7.8. Then we had nothing for basically the rest of the 50s. All right. And then we had, and going to the 60s, this is it. I know it's going to be hard to see, but we had 1.3 in 64, 63, 66, 65, 2.866. All right. So in 69, we had 5.4. That's, that's high, but that's not hyperinflationary. 5.7, 4.3, 3.2, then 6.2 right here. This is the oil shocks right here, 73, 74. So we had higher than average inflation. And, that could be because of the Medicare passage, the Great Society stuff, the Vietnam War. I mean, anytime there's a war, there's an inflation and stuff. So I'd attribute this to the Vietnam War, the Great Society. But then you go here, it's the shock, the oil shocks right here. 73, I mean, look, 72 is only 3.2, man. 73, 70, 74, 75 until 82. And then it starts going back down. So, I mean, that's it. I mean, I mean, I always go back to 66 just because that's the beginning from 66 to 82. The Dow literally did nothing. So everyone uses 66. But even 66, 67, 68, wasn't that bad. The issue is that the only inflation we've ever had in the United States is during wartime or during the oil shocks of the 70s. I mean, literally, that's it. It just hasn't been a big deal. And so all these people are saying inflate. Anyway, so I don't think it's insanely, I don't want to say insanely misguided. I think it's misreading history. And because of that, they're making a horrific mistake in regard that inflation is inevitable. That's my perspective for sure. All right, so let's see, chat. All right, so let's see. Let's see. Should I still? Okay, no, I got to go in there and change everyone's thing, which is going to be fun to hit holdings. I don't know why I didn't do that to begin with, but I just got to go in there and one by one change them all before y'all can see holdings. Jill says she only has about 10 to 12% of her bond funds as part of a diversified portfolio. I know you don't like bonds, but isn't it good to have this amount of buy and hold retirement portfolio? Yeah, I mean that's the thing, Jill. I don't like bonds, but the Wellington has a third of it's in bonds. So am I being, what's the word, hypocritical or even disingenuous? No. The bonds will give you, potentially, they will give you a reprieve from the market getting killed. That's a fact, we think. Obviously, long-term treasury bonds got smoked in February. But what I said, I'd rather have cash. I mean, you're not getting anything you're not getting the return for the risk on bonds, in my opinion. Why not just have cash as CDs? That's the way that's my argument. So I'm not against having bonds per se. I'm just saying, well, if I have a CD that's paying 1.5 and a bond that's paying 2, I'd rather have a CD that's paying 1.5 if I have to lock up a bond for 10 years. Now Wellington's got bonds. All right. So, I mean, the very next thing is, well, how can you like Wellington's got bonds? Well, the Wellington's being run by folks who know what they're doing. Hopefully when it comes to bonds, which I don't, you don't. Edward Jones got it. And I always pick on Ed Jones because they are notorious for selling bonds to conservative investors. And they just look at, they have this, they have an inventory is what all firms have this. They have an inventory that they bought for 99 cents on the dollar and they'll sell for you for 101. All right. So that's how they do it. There's nothing inherently wrong with that, but it's just what's their inventory based on? How do they know it's a good bond? Well, they just have credit ratings. That's it. And the credit rating agencies, you can't trust them as far as you can kick them. So when it comes to bonds themselves specifically, A, you shouldn't own them outright. No way. B, I would say if you do own them, have some CDs instead. And then C is like, well, don't you like Wellington? Yes, I do. And I like Wellington because it has a track record that's enviable, but that doesn't mean it's going to be persistent given the low rates of the interest rates that we're dealing with now. So frankly, I'd rather you have, just stocks and cash, but I get it. 15, 20% of bonds, bond funds, I can know, like Ginnie Mae, I just have no qualm with that at all. I just don't think you should have cash, bond fund, and Wellington. That's a lot of duplication on bond side. I don't think you should do that. I don't think you should have cash, bond fund. I mean, I think what you do in that regard is cash, bond funds, and stocks, or cash and Wellington, all right, or just cash and stocks. That's what it should be. So one of those three choices, but don't have cash, bond funds, and Wellington, because then you're having a whole lot more bonds than I think you're thinking you do. Not you specifically. Yeah, the VFIJX, there you go, the Admiral. 403B, but the 403B, right. And if you're in the TSP, the G Fund's great because it's guaranteed. I love the G Fund. I mean, the G Fund is the TSP version of the Ginnie Mae. It's 100% guaranteed. They're guaranteed not to make you much money. I get that, but all bond funds are guaranteed not to make you much money, but it's guaranteed not to lose, which I like a lot. All right, good. All right. What else, guys? So that's kind of what I want to chat on here today. Just want to talk about the tons of cash. I have tons of cash though, but my 403B earning 2 to 3% now is guaranteed. Yeah, that's what I'm saying. So tons of cash, but in my 403B, that's what I want to talk about too. So I forgot, I don't think it was on this one, but flexible retirement annuity. A client of mine out in North Carolina has a Fran that he took out in 2012 or 13. We've talked about the flexible retirement annuities here before on this SubscribeStar thing. And I'm a big fan of them. The drawback is they are going to the guaranteed minimum interest rate of all of 1%, which kind of stinks. I was hoping if you would have taken out the Fran in 2009 or 10, you would have got a guaranteed minimum interest rate of 3%. Which is smoking. Now those days are long gone. So the most or the least you'll get, the least you'll get is 1% right now, which is what it is. So it's across the board. In fact, actually, I think I did show you this last time, so I won't bore you here. But if you look at USAA.com and you type in annuities, you'll see they're paying nothing but 1% across the board. Like it doesn't matter. It's for long, short, it doesn't matter. Which is kind of disheartening. It's insane how low the interest rates are. And yet if people just would have bought the Fran, back in 2009 and 10, they would have had a guaranteed minimum of 3%. And, but a lot of people didn't do it because we all thought back then that, a 4% interest rate was way too low. Hyperinflation's coming. And going back to what you asked, AO 1, 2, 3, 4, 5, AO 1, 2, 3, 4, 5, A0 1, 2, 3, 4, 5 is buying tips insanely misguided. I would say yes in my own case. I remember it was like it was yesterday. Recommending freaking, staying short on bonds back in 2008, 9, 10, simply because the federal government printing money like a drunken sailor, Helicopter Ben, and saying this is inflationary. There's no getting around it. Milton Friedman, inflation is always and everywhere a monetary phenomenon. And we're all wrong. I mean, the monetarists were wrong, man. The Keynesians have been wrong during the Nixon era. The monetarists are wrong now. And that's why I was reading a guy, I think I said this in a video the other day. I don't think Ginnie Mae is paying 2.48 right now, Rick. In fact, I would look at Vanguard specifically. What are you looking at? The Yahoo Finance I don't Yahoo Finance is I like them for the historical numbers, but if you're using that for yields, I would not. Let's look at Vanguard's. Yahoo. Don't use Yahoo for that. They're bad. They're actually they're bad. Their numbers are jacked up. So let's just go to Vanguard.com and look up the. Oh, by the way, I'm not a fan of Vanguard's managed payout fund. I get this question a lot. I'm just not a fan of that. Just not enough track record to see if it's going to make it. It's just not a good. There's no track record to see what it's going to do. So a lot of people say, "What do you think about Vanguard managed payout?" They're trying to keep like a 4 to 5% payout. It's impossible to do without tapping in principal. And the minute you start tapping in principal, you're paying that kind of yield. It's that payout. It's only a matter of time for you to run out of money. Right now, Vanguard is paying, let's see, I think it's 1.79 or 69, 1.98. So it's paying a little bit more than it was just the other day. So 1.98. So that's not bad. What was I just talking about before that? I was talking about something. I thought I was going to share something profound. Talk about the yields, monetary. So everyone's saying that inflation is everywhere a monetary phenomenon. It's simply not true. Inflation is everywhere and everywhere, in my opinion, now a socialistic phenomenon. If the demand isn't there, and there's no price controls, there's no inflation. That's just all there is to it, as Japan can attest to for sure. And so what's happening here is that if you bought the tips under the Milton Friedman school, like I would have recommended you do back in the late 2000s, late aughts, you would have, well, actually, it probably wasn't a bad investment because interest rates have gone down over the last 10 years, but it's not worth, it wasn't a good move. And so now we see that. And that's where I think that's what I was saying. So a guy I follow, a right-wing economist, I think, was bashing modern monetary theory and saying that they take no concern about inflation, and that's just simply not true. And look, I'm not a proponent of modern monetary theory in the least, but I think it has there are some times it's legitimate, like during the quote stimulus. That makes sense for sure to get money into the hands of people to consume it. We're not stimulating anything. We're just replacing what has been lost by government dictate. But anyway, the right-wing economists can also be mistaken just as much as the left. And the right-wing economists who say modern monetary theories, MMT doesn't pay any attention to inflation. That's a straw man. It's a straw man. And they should not do that. The right-wing should be a little bit more legitimate in their arguments, because then we start sounding like lefties. And we're better than that for sure. Cash, 2 to 3% cash is not pretty doggone good. It's freaking fantastic. That's for sure. Why not cash, CD, Ginnie Mae? Yeah, Bob, that's cash, CDs, Ginnie Mae, and VTSAX, 100% right. When you draw out money from Wellington, you can't withdraw just the stock part or just the bond part. Yeah, I 100% agree. Cash, CDs, Ginnie Mae, and VTSAX, total bond, the total market, total stock index. That's my ideal portfolio for sure. I love it. You cannot just take stocks or bonds out of the Wellington. That's one of the huge drawbacks. The problem is a lot of people just want to keep it simple, stupid, routine, and that's fine. That's why the Wellington is so great, is to keep it simple, stupid. Let me just share with you some things on Wellington just while I'm yapping here, and then we'll get you guys out of here. So you can't really see it, I guess because it was blinded. But anyway, so you see. What I got here is I said, okay, we're doing all these different scenarios, 1930, 1931, 1966, and 1973, using 4% fixed, where it's just $4,000 a year, not adjusted with inflation. And everyone would say, that's stupid. Well, it wasn't stupid in the 1930s. It wasn't, because there was huge deflation. So 4 or 5 or 6,000 a year, even 5,500. So we're going 4, 5, 6, 4, 5, 5.5, 6. We're sitting at fixed. So in 1930 and 1931, that was essentially inflationary, because you were taking 4,000 a year out while the price of goods was dropping. Now it's in 70 and 66 and 73, that was bad. But then we're doing that fixed. They were doing adjusted for inflation. Then we're comparing that to the S&P 500. And the interesting thing is, in 1966, and I'm using no return on bonds at all, just saying big fat goose egg, no return on bonds. And this is, I was listening to a guy today, someone had emailed me this video on, I was watching this guy while I was walking, a math professor seemed like, if I can find, hold on just a second. It's interesting, his name was Big M, Big EM, a retirement withdrawal savings. It was interesting, and I guess he's known to challenge the 4% rule, and that's fine. But which I like. Anyone who challenges the 4% rule, I'm a fan of. But anyway, and he did all these different mathematics things where your spending goes up by 50%, spending goes down by 50%. And all I thought that was good. But he was still using historical rates of returns on bonds, and I just. You can't do that. You can, so all the previous studies of the Trinity, the 4%, the Bengen rule, all those you can't use anymore because those all are concluded with the bond rates that are not here today. I just cannot stress that enough. You can't. So for me, I'm using literally what we're getting on bonds, which is basically nothing. I mean, we're getting a little bit more, but I'm using a 0% rate of return on bonds. And the 4% rule adjusted for inflation would have failed in 1966. It would have succeeded in 1973, all right? It would have succeeded in 1930, 1931, and 1973. Those are the worst years, 1973, 1966, 1930, and 1931. A 5% rule adjusted with inflation would have failed in 3 of the 4 years, 1930, 66, and 73. And it goes out saying if 5% would have failed, 5.5% and 6% would have failed. All right. Now those are adjusted with inflation. Now, what if you had fixed rate of return? All right. So again, you're taking in the 30s, the market is going, the price of goods is going down, and you have a fixed rate. Is that not the same as adjusting for inflation? Of course it is. So if you had a fixed rate, the 5% would have been succeeded in 1931, 1966, and 1973. In fact, every single time, if you would have started in 1931 as opposed to 1930, even with a 6% fixed at 6,000 a year or adjusted with inflation, which at first would have gone down, then would have gone up, you would have been successful every single time. If you would have had a 6%, a 5%, a 5.5%, I can't remember. I think I even did 7. I just can't remember off the top of my head. But isn't that interesting? And that's with just using Wellington. All right. So now what we're going to do next, I don't think I have it here, is we use the barbell to do the same thing. The barbell assumes, and I'll just share with you some numbers here real quick, just while I'm yapping to get you guys stoked for the book. Let me go to share screen. Right here, blink, and we're going to go to the barbell, and this is going to be pretty cool. I think, is this where I have all my numbers here? Yeah, okay. All right, so right here, you would have, let me go over here. So right here, so Dana, this is what I was trying to do in the barbell. You can see you would have ran out of money, 6% withdrawals, all right? So what that means is, you have 4 years of cash set aside, making no money, and you got the rest in the Wellington, in Wellington. 4 years of cash, the rest in Wellington. Even at 6% adjusted with inflation, you would have only ran out of money in 1952. So your portfolio would have lasted for 22 years at 6% a year adjusted with inflation. Tell me that's not pretty cool. Now, if we go down a little bit, if you would have started in 1931 at 6% adjusted with inflation on Wellington, the same thing, 24% 4 years in cash, the rest in Wellington, you would have had money until 1960. You would have actually had money until 1965. So you would have lasted 35 years. If we keep going down, I forgot what this is, 1966, you would have ran out of money in 1981. All right, so that's only 15 years. So 1966, adjusted with inflation, it was doomsday scenario. Again, that's at 6% a year. 1973, adjusted with inflation, you would have ran out of money in 1987 about. So you would have ran out of money 13 years later. The inflationary times of the late 60s and 70s, to say it again, killed us. 6% a year adjusted with inflation starting in 2000. At the end of 2019, you still had it's about $50,000 left. So you lived for 20 years in some of the worst markets we've seen, and yet you adjusting 6% a year, adjusted for inflation, and yet 20 years later you still have more than half your portfolio available. Tell me that's not pretty cool. And then I got let's see, I got even 7. Oh, that's no, what is that? 3 years. So I do all kinds of things down here. It's pretty cool. So, and that's what I've been working on. Just these little. I've had to manually do this, Daniel. So I was hoping you could give me some kind of thing where I could just kind of click, and it'd show up for me. But it's no big deal. I just have to kind of, I mean, you can see what I'm doing here. Well, I'm just highlighting these, these columns and then inserting a chart there. Well, it's cool. It's all good. But anyway, so that, I think what I did is 7%. Let me just see 7%. And we ran out of money in 1931 right there. So even if that's 7%, now this is 1931, you still had your money for 21 years. Taking it, that's a flat 7%. Hold on just a second. If we adjust it for inflation at 7%, this is the Wellington, you ran out of money year 1955. So at 7%, it's still, you had 25 years, man. That's what drives me crazy about the 4% rule, is that it's your safe withdrawal rate. You're safe, but that means that means you have to live for 30 years and only spend 4%. Now, again, this is silly now, and again, I'm not giving you any rate of return on cash. And you still had, 20 odd years in the 30s, that's 7%. It's like, why hamstrung yourself we're not even reducing our expenditures. Now, one of the things I am doing is I'm going back. What if we did 6%? What if we did 5%? What if we did 4%? Every 10 years or something like that. That's what I'm working on now. That's why I'm not getting this book done, because I keep coming up with these ideas. 6. What if I did 7, 6, 5, 6, 5, 4, stuff like that? Just because as you get older, your expenditures go down. So that's what I'm starting to do. All right. High yield savings accounts are paying 4% with promo rates. Yeah, man. Exactly. And is the 4, 5, and 6% of the balance always at the start or end of the year or the start of your retirement? I'm not sure what you're saying. Is the 4, 5, or 6% of the balance always at the start of the year or the end of each year or at the start of your retirement? Do I use the amount I had in February when I started retirement, the amount I have when I start withdrawals? Yeah, I would just do when you start withdrawals. I mean, yeah, because it doesn't matter if it's a hindsight for sure. It doesn't matter. I mean, because what you did in the previous doesn't matter. So you say, how much do I have now? How much do I need? That will be the amount that you'll take as a distribution. Hope that makes sense, Jill. Book is on its way. Don't forget, guys, if any of you are still here, if you want a signed copy of this, let me know. I'll sign it for you, and I'm mailing it off. I'm charging $15. I hate to even do that, but I'm a dirty capitalist, and I like money. But anyway, yeah, sweet. That you just bought a Kindle version of this and went on sale for 99 cents of this book? I don't think this book went on sale. I think that shouldn't have gone on sale. The hard copy of this is freaking $19, man, because it's all colored and stuff. Anyway, I got like 100 sitting in my thing here. I said, well, if people want them, just let me know, and I'll mail them to you. I got to give it to the post office. Probably not tomorrow, but I've had I think I've sold 10 of them so far. It's cool. A couple guys wanted, for the kids and whatnot. I'll sign a little thing that says, dear Mickey and Minnie Mouse, or whatever the kid's name is, whatever, blah, blah, blah. It's cool. So anyway, but I appreciate you buying the book, man. But it shouldn't have been this for 99 cents. So that's not good. The Kindle version, every now and again, Amazon runs sale prices, which is actually pretty cool, because it keeps my book top of mind awareness out there. But when you actually real quick, when you're opening an Amazon, when you're doing a book and you do it on Amazon, they ask you if you allow Amazon to have basically exclusive rights. And when you give it, this is my understanding, when you give them exclusive rights, they have the ability to to do kind of sale prices and stuff, you know, because they make money off the Kindle. It's interesting too, by far and away. I just looked at the numbers today. I'd say by a factor of probably 8 to 1, I make more revenue on Kindle than I do on hard copies. Never would have thought that. Never would have thought that. But by far and away, I make more on Kindle than a hard copy, which is interesting to me, because I would have thought it'd been the other way around. But I guess for the shipping and the printing and all that, it takes so much. It's not even close. So I mean, it's if you're thinking about doing a book, it's so flipping easy to do. I wouldn't even mess with a hard copy, especially if it's like a fiction. All my fiction I read anymore is on my phone, my Kindle. I got Kindles all over the place, but this is my Kindle. So I just got done reading this book. Let's see if I can still show it to you. It's actually, if you like baseball, and I miss baseball. I never thought I'd miss baseball this much, but I've missed baseball something wicked, because the summer's here. Basically, there's no baseball. It's like depressing. Yeah, physical publishing is dead. Well, no, not true. Everything technical or science or everything I need, right, where I need to think about it and highlight it. Anything that's technical, economics, science, I need a hard copy. I need to highlight it. I need to have it in my hands. I cannot do that on a Kindle. But anyway, got done reading this book. I should have quit this morning. Oh, geez Louise. Oops. Hold on a second. It's a minor league book. It is, hold on a second. Let me go to cover. Forget it. All right. It talks about the minor leagues. It's insane. You think it's all glamorized and, you know, romantic. This book right here, I think you get that on, man, that's how hard. I got to get rid of this background. I should have quit this morning. It's a minor league baseball book. Adventures in my, I don't know how these guys do it. Yeah, exactly. I buy signed copies too. In fact, I got signed copies of Thomas Sowell, Milton Friedman, Paul Hollander, who died, other people. But anyway, if you're interested in baseball, minor league stuff, that book is great. I love it. Anyway, so the Kindle version of this book is, collectors, exactly, is $9.99. Okay, that's even more expensive than I would have thought. That's probably a little too. Yeah, $4.99. All right, my friends. Well, I appreciate it. We're gonna go find something to watch with my wife. We just got done watching World at War. It was okay. I wouldn't recommend it. We like the 1800 19th century English stuff. Never thought I'd like that. Masterpiece and all that. It's fun. And so we're going to go find something else to watch. There seemed like something. Oh man, I'm drawing a blank what it was. My daughter was reading one of the books. And I said, I think it's we'll go check it out. But and of course, Pablo likes to jump in there and hang out with us too. So every Wednesday, 7:30 p.m. Eastern time. Denise, I'm glad you could be here. Everyone else from California, Dan, thanks for being here. I'll put the link into the show notes for Dan's YouTube channel. Dan, hate to put you on the spot, but if nothing else, at least you'll have this video out there for people to see how they can do the technique that you showed us, so that way they can have access to the info on the investment stuff. And I will go ahead and one by one give you guys access to holdings. I don't know why I didn't do that to begin with, but right on. Dan's got a subscriber, cool. But I should have done that to begin with, but there you go. I appreciate it. Thanks for being here, everybody. See you all next week.